Everyone, back with me again in this channel. Don't forget to like, to share, and to subscribe this channel. This week, the Federal Reserve takes center stage with expectation for another big hike coming, while the biggest companies in the world and much of the S&P 500 as a whole share their reports. Economic data and continued development out of Ukraine will also mark the week ahead. Here is what you need to know. Federal Reserve meeting inflation reports have remained elevated, and that's led just about all markets prognosticators to expect at least a 75 basis points hike from the Federal Reserve. 1,000 basis points hike was briefly on the table, and Fed funds future prices suggest a 20% chance of that still happening, but reports suggest that the Fed won't go quite that far. The FOMC statement and Fed Chair Powell's press conference will be in some ways more needle-moving for the market, as the market tries to size the possibility of a recession and how committed the Fed will be to tamping inflation if the recession shows up. With thought already of rate cuts coming next year, the phrase threading the needle is sure to come up a few times this week. Is U.S. recession inevitable, and what will it do to the price of oil? Weekly jobless claims among Americans have hit 5-month highs, while sales of existing homes are down a fifth straight month amid a 9-month low in home building. These are signs of trouble in the labor and housing markets, the other two principal drivers of inflation in America besides oil. On the energy front, U.S. crude oil prices have fallen 3 weeks in a row, losing 13% in that stretch. Brent crude finished in the green last week, but not before losing 17% over 5 straight weeks. At the pumps, U.S. gasoline was at $4.38 a gallon across the country of July 23rd, down from the last month's peak of more than $5 a gallon. To top it all, the Federal Reserve will likely impose a 75 basis point hike for July at its monthly rate decision on Wednesday. If so, it will be the second straight 75 bps hike that will take rates from a range of 0 till 0.25% in February to 2.25 to 2.50% by the end of this month. With 3 more rate decisions left for this year, Fed officials are indicating a hike of 3.5% or even 4% for rates by the year end. But money market traders are also pricing in rate cuts by 2023, with the implicit prediction the economic fallout from the Fed hikes will be too great that the market is even contemplating a fresh easing by next year. Thus, economists that the risk of a Fed-induced recession between now and then is reasonably high. The U.S. economy has already contracted 1.6% in the first quarter, and the second quarter in the red is all that's needed to technically call a recession. U.S. tax data at least suggests that aggregate labor income reflecting gains in wage, hiring, and incentive way across the economy has hit an inflection point, and that labor income is now shrinking in real terms, making a job market slowdown more likely. Matt Trevisono, who tracks tax-wide holdings for investors at dailyjobsupdate.com, has been quoted as saying that he expects the 372,000 jobs gain in tune to be revised away in the future with the possibility of a nasty reversal in monthly jobs data. Maybe that's all from me, guys. Thank you for watching. Don't forget to like, share, and to subscribe this channel. See you next time.